오늘 소개하는 영상은 주식 투자에 관심이 있든 없든 관계없이 영어 공부에 도움이 될 만한 영상을 준비했습니다. AI 버블이 닷컴 버블보다 훨씬 크다고 경고하고 있는 오마하의 현인 워런 버핏의 영상입니다. 자, 그럼 들어보시죠.
But what happens when, not if, but when interest rates need to rise again? Or when the economy slows and investors start demanding profits instead of promises? That's when we'll see who's swimming naked, as I like to say. And right now, I suspect there are a lot of naked swimmers in the AI pool. Here's another parallel that keeps me up at night: market concentration. At the peak of the dot-com bubble, the top 10 stocks made up about 27% of the S&P 500's total weight. Today, the top 10 stocks represent 39% of the index. That's not just concentration, that's dangerous concentration. If, or more likely when, these stocks correct, they won't just drag down the technology sector, they'll take the entire market with them. Your 401k, your pension fund, your index funds, they're all loaded up with these same companies. The average investor thinks they're diversified because they own an S&P 500 index fund, but they're really making a massive bet on 10 companies, most of which are spending unsustainable amounts on AI infrastructure. And here's the thing that really bothers me. We know how this story ends because we've seen it before. After the dot-com crash, it took the NASDAQ 15 years to get back to its March 2000 peak. An entire generation of investors learned the hard way: the trees don't grow to the sky. But the most concerning aspect isn't the spending, it's the revenue gap. According to recent research, big tech has invested about $560 billion in AI infrastructure over the past 2 years. The combined AI-related revenue from Microsoft, Meta, Tesla, Amazon, and Google, about $35 billion. That's a 16-to-1 ratio spending to revenue. Now, I'm not a math genius, but I know that you can't spend $16 to make $1 and call it a good business. Some of this spending will pay off eventually, sure, but all of it, not a chance. MIT recently did a study that found 95% of AI pilot projects fail to yield meaningful results. 95%. That's despite more than $40 billion in generative AI investment. The gap between the hype and the reality is wider than the Grand Canyon. What really concerns me is the psychology behind all this spending. It's not based on careful analysis of returns. It's based on fear. Fear that if you don't invest now, you'll be left behind. That's the same psychology that drove the dot-com bubble, the housing bubble, and every other bubble in history. In my 2000 shareholder letter, I wrote about how investors were like Cinderella at the ball. They knew that staying too long would turn everything to pumpkins and mice, but they hated to miss a single minute of the party. Today, we're seeing the exact same behavior, just with artificial intelligence instead of the internet. The party's in full swing right now. The music's playing, the champagne's flowing, and everyone's having a great time. But I've been to enough parties to know that they all end the same way, with someone stuck with the cleanup bill. You know, people often ask me what the secret to successful investing is. They expect some complicated formula, some sophisticated algorithm, but the answer is simpler than they think. Don't lose money. That's rule number one. Rule number two is, don't forget rule number one. It sounds simplistic, but think about what it really means. If you lose 50% of your money, you need a 100% gain just to get back to even. That's not a game you want to play. And right now, with AI valuations where they are, I see a lot of people playing that exact game. Let me tell you about a study I came across recently. A researcher named Kai Wu examined major capital expenditure cycles throughout history. Railroads in the 1860s, automobiles in the 1900s, radio in the 1900s and 1920s, the internet in the 1990s. You know what he found? In every single case, the companies that aggressively grew their balance sheets through massive capital spending underperformed conservative peers by an average of 8.4% annually. Let me say that again. The aggressive spenders lost to the conservative companies by 8.4% per year. Over a decade, that difference compounds to a massive underperformance. The patient investor beats the aggressive spender almost every single time. Why does this happen? It's not complicated. When companies race to build capacity, whether it's railroad tracks, fiber optic cables, or AI data centers, they create massive overcapacity. Supply exceeds demand, prices fall, returns evaporate, and investors are left holding the bag.
여기서 잠깐 left holding the bag은 다른 사람은 책임을 회피하거나 도망간 상황에서 혼자만 책임을 지게 되거나 손해를 감수하게 된다는 의미의 영어 표현입니다.
Right now, we're seeing the exact same pattern. Companies are building AI infrastructure at an unprecedented pace, all betting that demand will be there to justify the investment. But what if it's not? What if AI adoption is slower than everyone thinks? What if newer, more efficient technologies make current investments obsolete? I learned a valuable lesson from my mentor, Ben Graham. He taught me about the margin of safety, the idea that you should only invest when the price is significantly below the intrinsic value, giving you a cushion against mistakes or bad luck. Today's AI valuations have no margin of safety. They assume everything goes right, perfect execution, continued technological progress, unlimited demand, no competition, no disruption. In my 70 years of investing, I've learned that everything rarely goes right. Usually, something goes wrong. Sometimes everything goes wrong. That's why you need a margin of safety. Let me give you a concrete example of what I'm talking about. Cisco Systems was the darling of the dot-com era, the picks and shovels of the internet revolution. At its peak in March 2000, Cisco had a market cap of $555 billion, making it briefly the most valuable company in the world. The stock traded at a price-to-sales ratio of 35 and a PE ratio above 200. Everyone said Cisco was different. It had real revenue, real profits, real products. It wasn't some pie-in-the-sky startup. And they were right. Cisco was different. It survived the crash. But the stock, it fell 86% from its peak. Even today, 25 years later, Cisco trades below its 2000 high. Think about that. If you bought Cisco at the top of the market, thinking you were investing in a solid, profitable technology leader, you'd still be underwater a quarter century later. That's not even accounting for inflation.
구독과 좋아요는 제작에 많은 힘이 됩니다. 감사합니다.